Okay, so return on investment, one of two, measures the amount of income an investment center earns relative to the size of its assets. I mentioned that to you before. Investment center is all about the income, that profitability it has relative to the fixed assets that it's using to generate that income. So the ROI, the return on investment, is computed by taking operating income divided by total assets. Naturally, the higher the ROI is, more desirable. So you can get a higher ROI by two ways. Generate a ton of income, that's going to give you a high ROI, or keep your total assets really low. Managers start to learn that, and at some point in time, we'll talk about why that could be a bad thing for a company. So return on investment, ROI, if we look at the 2015 division data, we'll see PepsiCo, their operating income is $27.85. Their investment in assets is $28,128. So I think this is going to be, this is all in millions. So this is going to be $2,785,000,000. The investment in assets is $28,128,000,000. And sales revenue is $20,618,000,000. The Frito-Lay North America snack is operating income is at $4,304,000. The assets are $5,375,000,000, and the sales revenue are $14,782,000. Now, if we're going to look strictly at operating income, you'll see, well, Frito-Lay must be beating the pants off PepsiCo, because look, its operating income is $4,304,000 compared to $2,785,000. So right off the top, we're kind of pleased with that. But it's actually even better than what we think, because we're going to compare that income relative to the amount of assets. If we look at the beverage division and we compute the ROI, remember the ROI is operating income divided by total assets. Well, that makes things relatively easy. We're going to take PepsiCo's operating income and we're going to divide it by total assets, $28,128,000,000. So this divided by that will give us 9.9% return. The snack division ROI, we already thought it was better in terms of income, but look, it's a lot better, because we're generating $4,304,000,000 in income, and we've only invested $5,374,000,000. So we're getting an 80.1% return on investment for snack divisions. That's a healthy return for any company, but particularly for a snack division. And you can see, absent of anything else, you might even think Pepsi would say, well, why do we even have a beverage division if our return on investment is so low? But this is just one measurement. You have to take into consideration a lot of different measurements. There are other ways we can compute the ROI. And the way we could do this is we could take the sales margin. Let's go from the bottom up. It'll be a little bit easier. The sales margin multiplied by the capital turnover. Well, how do you get the sales margin? Sales margin is computed by taking operating income and dividing it by sales. Sometimes we think of this as the profit margin, but we're going to call this the sales margin for now. And we're going to multiply this by the capital turnover. The question is, well, how do we come up with the capital turnover? Sales divided by total assets. So these two are going to generate, this is going to generate a percentage or a decimal, and this one is too, although most likely this will be over 1. Most likely this will be, well, it will be under 1. This will be, in most cases, most likely it's going to be over 1. So let's look at the sales margin example. focus on profitability by showing how much operating income the division earns on every dollar of sales revenue. We're comparing profitability to sales dollars. So sales margin is equal to the operating income divided by sales. Now, without looking at this, you can go and try to look at the previous, without looking at the answers here, you can try to go back and look at the previous, what was it, 2 screens ago? Yeah, right here. And see if you can come up with those answers, with those dollars. Sales margin, operating income divided by sales revenue. Go ahead and pause and try to solve. Okay, so if you try to solve, we'll start looking at it together. So for the beverage division, the operating income is $2,785,000. Let's confirm this. Yep, operating income for the beverage, 2,785. We're going to divide that by sales. We haven't used that one yet for computations. Here's the sales revenue, $20,618,000,000. 2618. Operating income divided by sales. Our profit margin, or I'm sorry, the sales margin is 13.5%. That's for the beverage division. We'll do the same for the snack division. You can go back and check, but I'm sure these numbers are right. $4,304,000,000 divided by $14,782,000,000. Go back to the previous slides if you're not sure where those numbers came from, but it'll be on that table just like what we looked up here for the beverage division. That gives us 29.1%. 29.1% means we now can compare our snack division to our beverage division in terms of the sales margin. Again, the snack division seems to be much better when looking at the sales margin. Now we're going to look at the capital turnover. Remember, we said we could get to an ROI if we take our sales margin and we multiply it by the capital turnover. Well, we just figured out how to do the sales margin. Now let's take a look at how the capital margin works. That's another formula. The capital turnover is computed by taking total sales, and we're going to divide that by total assets. Total sales divided by total assets. Let's go to the snack division so that we're not always confirming certain numbers. The snack division shows $14,782,000,000 in sales. Let's go back and confirm. Sales revenue for the snack division, $14,782. 14,782 divided by total assets, 5,375. 5,375. So it comes from the data that's provided. Again, we can see that the capital turnover is significantly better for the division because they're able to generate $14,782,000,000 in sales with an investment of only $5,375,000,000. While the beverage division is generating more sales, $20,618,000,000, relative to the assets, it's not as much as what you would expect, or at least compared to the snack division. It's at 0.73 in terms of the capital turnover. Now we have the residual income, the RI, another computation. The RI determines whether the division has created any excess income above and beyond management's expectation. Residual income, RI. The way it's computed is we take the RI, and that equals operating income minus minimal acceptable income. The RI is equal to operating income minus, well, we already know that, we've already said that, but let's get more specific here when we're saying the minimal acceptable income. What does that mean? Well, let's see. We'll look at target rate of return times total assets. So we're going to set this target rate of return. This is what we really would like to have, a rate of return times the total assets. Well, let's take a look. It looks like somebody in management decided that we want to target our return as rate of return is 0.25, 25%. So in other words, we want to generate at least, in terms of operating income, 25% of what we've invested in assets. Okay. So we can focus now on the beverage division. And the beverage division income, operating income, we won't go back and look because we know it's okay. $2,785,000. We have, management has decided that what we really want is 25% of our investment in total assets. If we go back to our data, we'll find that the total assets is $28,128,000,000. So 25% or 0.25 multiplied by 28,128,000,000 gives us something like 6 million. Well, let's do the computation. So this is going to be 2785. That's the operating income. And then we're going to say plus 0.25 times 28,128. That's 7,032. And then we're going to find the difference between the two. 2785 minus 7032. So I guess I should put a minus sign there to make it obvious. So the operating income minus the target income, which we computed by this, equals negative 4247. Well, because it's negative, and negative is represented by parentheses in this case. So if it's less than 1, then you'll put it in parentheses. In my example here, it's negative, but if I had the right format, it would be in parentheses. Or brackets. You really should think about it as brackets. So for the beverage division, missing again, they're 4,247,000,000 shy of what the target income should be. For the snack division, though, we won't have to worry about doing the computations. For the snack division, though, their operating income is 4,304,000,000. We're going to subtract from that the target, which is 25% of the assets. This is in the data table. You can go back and look, but these are the total assets. 0.25 multiplied by 5375. That product will be subtracted from 4,304,000, and the result is going to be 2,960,000. That's going to be positive. So definitely the snack division has residual income. The beverage division, not really, because if it's in negative, they don't have any residual income. Okay, so the summary of the investment center performance measures that we just learned: ROI, there's the formula; the sales margin, there's the formula; the capital turnover, and the residual income. All those will be performance measures that we use to measure the performance of specific investment centers. Now, we mentioned this word before. They call it goal congruence, and I think we identified it as a disadvantage of decentralization. Residual income often leads to better goal congruence than ROI. So if our goal is to get everybody to working together, we want everybody moving in the same direction, then we might look at residual income as a way of measuring performance. Or we're not going to let any one of these go, but we might focus more on residual income because it leads to better goal congruence. We get more of the managers working towards the same goal. And when you're using a decentralized organization, you're going to be battling that all the time. So you want to have goal congruence. Now, there are some things we need to take into consideration when we're putting these numbers together. Specifically accountants, but also you as managers, because most of you won't be accountants. You as managers want to understand when the accountants are bringing these numbers to you, that there may be some things to consider. The question is, well, which balance sheet date should you use when you're trying to come up with total assets? Is it the beginning? Is it the ending? It's a good question, because if you're using sales, that occurred throughout the entire year. Should we include all assets? I guess what you could be arguing is that certain divisions may have like a heavy investment on specific elements that they can't even exist without buildings, without structures, without machinery equipment. Is it fair for those companies to be measured on that scale because they require that kind of an investment? Should we use the gross book value or net book value of the assets? It's a good question. The gross would be what the original cost was. The net would be the cost minus accumulated depreciation. And should we make other adjustments to income or assets based upon the specific areas or characteristics of the segment that we're trying to measure?